Coming to inflation, the headline inflation moderated during January-February 2025 following a sharp correction in food inflation. The outlook for food inflation has turned decisively positive. The uncertainties regarding Rabi crops have abated considerably, and the second advance estimates point to a record wheat production and higher production of key pulses over that last year. Along with robust Kharif arrivals, this is expected to set the stage for a durable softening of food prices. Sharp decline in inflation expectations in our latest survey for 3 months and 1 year ahead would also help anchor inflation expectations going forward. Furthermore, the fall in crude oil prices augurs well for the inflation outlook. Concerns on lingering global market uncertainties and recurrence of adverse weather-related supply disruptions, however, pose upside risks to the inflation trajectory. However, I may add that as per the latest forecast by various organizations, national and international, including our own Indian Meteorological Department, the monsoon is expected to be normal, and the El Nino effect is also expected to be absent. So these are positives for us. Taking all these factors into consideration and therefore assuming a normal monsoon, CPI inflation for the financial year 25-26 this year is projected at 4%, with Q1 at 3.6%, Q2 at 3.9%, Q3 at 3.8%, and Q4 slightly higher at 4.4%. The risks are evenly balanced. I now will be speaking on the external sector. India's services exports remained resilient in January-February of this year, driven by software, business, and transportation services. Going forward, net services and remittances receipts are expected to remain in large surplus, partly offsetting the trade deficit. The current account deficit for last year as well as this year, 25-26, are expected to remain well within the sustainable level. On the financing side, gross foreign direct investment, FDI, remained strong during the period of April 24 to January 25. Last year, which is the latest data period for which we have the latest data, reflecting India's strong macroeconomic fundamentals. Net FDI, however, moderated sharply during this period due to higher repatriations and outward FDI. Net FPI inflows to India stood at $1.7 billion during 24-25, supported by debt inflows as the equity segment recorded net outflows. This is much lower than what we had last year. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to that last year. As on 4th April 2025, India's foreign exchange reserves stood at $676.3 billion, providing an import cover of about 11 months. Overall, India's external sector remains resilient as the key indicators stay robust.